What's going on, guys? It's Brad here, and today we're talking about one of those things that's so important in life that you probably didn't learn much about in school, and that is your credit score. Your credit score is like your financial reputation, and it's a reputation that you need to build deliberately and strategically. In this video, I'm going to break down exactly how to build your credit from zero to an excellent score that opens doors to better rates, better cards, and better financial opportunities. First of all, it's important to understand what a credit score actually is. A credit score is a 3-digit number that represents a person's creditworthiness. That is, how likely they are to repay debts based on their financial history. It's used by lenders such as banks, credit card companies, and mortgage lenders to decide whether to approve loans, credit cards, or other financial products, and at what interest rates. Whether you have a credit card, a mortgage, student loans, or any other type of loan, information about those accounts is reported to credit bureaus like Equifax, Experian, and TransUnion. And these companies use that data to calculate a score for you that can be obtained with your permission by other potential creditors and companies you'd like to do business with. Credit scores range from 300 to 850, with higher scores indicating better creditworthiness. So the closer you are to that perfect 850, the better products and better terms you'll qualify for. Credit scores are also often used for rental applications and utility accounts to determine if you need a guarantor or to make an additional deposit in advance. So even if you don't need a loan or anything like that, your credit score can still have an impact on your life. And actually, the perfect time to build your credit is long before you need to borrow money for something like a mortgage. So when that time comes, you'll already have a proven track record of making payments on time. Now, there are a lot of legitimate criticisms of the credit bureaus and the credit system as a whole, but as of now, for better or worse, this is the system we're operating within. So I want to make sure you have the information you need to thrive within the system as it is. With all of that said, how exactly do you start building your credit? It can be tough when you're starting from zero. It can feel like one of those chicken and egg problems where you need credit to be able to build credit. But I'm going to show you a step-by-step process that you can use to start building that credit history from scratch today. To do that, we first need to understand what factors go into your credit score. So let's break those down. Number one is payment history. This is the single most important factor, accounting for 35% of your credit score. To put it simply, payment history is about whether you've consistently made your credit payments on time. Ideally, you want your payment history to be 100%. Missing a single on-time payment can lower your credit score for years. Number two is your credit utilization rate, which accounts for 30% of your score. Your utilization rate is the amount of credit you're actively using relative to the amount of credit you have available. So as an example, say you have $10,000 in credit available and you have a reported balance of $1,000. That is a 10% utilization rate. Ideally, you want to keep your utilization rate at 30% or below. The next factor is your length of credit history, which is 15% of your score. This is about how long you've been using credit, and it comes from how long your credit accounts have been open, the age of your oldest account, the age of your newest account, and the average age of all of your accounts. Basically, having a longer track record of responsible credit use is good for your score. Next, we have credit mix. This is 10% of your credit score, and it takes into account the different types of credit accounts that you have. For example, credit cards, installment loans, mortgage loans, and so on. You don't have to have all of these, but some variety is beneficial to your score. Finally, we have new credit applications, which is also 10% of your score. Whenever you apply for a credit card or a loan and they pull your credit report, that appears as an inquiry on your credit report, which impacts your score. The idea here is that if you're applying for a lot of new credit in a short period of time, you may be a more risky borrower. So those are the factors that go into your credit score. And with all of that in mind, let's talk about how to actually start building your credit from the beginning. Step one, become an authorized user. Now, this is not required, But if you have the opportunity, the fastest way to start building credit from scratch is by becoming an authorized user on someone else's credit card. This could be a parent, a sibling, a spouse, or significant other. But here's the key. It needs to be someone who has an excellent payment history, keeps their credit utilization low, and has had the card for several years. When you're added as an authorized user, you essentially get to share their credit history from that account, and it reports to the credit bureaus under your name as well. That means if they've been making on-time payments and keeping their credit utilization in check, that positive information will show up on your credit report, giving your credit history an instant boost. Now, while this is a great way to get started, it's important to remember that this is just a foundation. You can't rely on somebody else's credit for too long. You'll want to start building your own credit history as soon as possible, which brings us to step 2. Get your first secured credit card. Whether or not you go the route of becoming an authorized user, your credit history is going to be pretty limited at first. And if you just start applying for credit cards, most of them are probably going to deny you. This is sort of that chicken and egg problem, right? You need credit history to be able to build credit history. But the way around that is by signing up for what's called a secured credit card. Here's how it works. You put down a deposit, usually somewhere between $200 and $500. And that amount becomes your credit limit. It's a way for the credit card company to minimize their risk because they already have that deposit as collateral. Now, after a few months of using the card responsibly, they will refund that deposit to you. So you'll want to look for a secured credit card that has no annual fee and reports to the major credit bureaus. 2 really popular options are the Discover It card and the Capital One Platinum card. Step 3. Set up autopay and pay your balance every month. Once you've got a secured credit card, the first thing you'll want to do is set up autopay to pay off the full balance every month. The most important rule with any credit card, secured or unsecured, is never, ever miss a payment. Autopay is super convenient to set up, and it's going to save you a lot of headaches down the road. And I want to emphasize here, you do not have to carry a balance from one month to the next. You do not have to pay any interest. Just treat the card as if it's cash coming directly out of your bank account and pay it off automatically in full every single month. Step 4, start using your card for small purchases. Something you'll want to be aware of as you're using your new card is your credit utilization rate. Remember, this has a big impact on your credit score, so it's important to keep it low, ideally below 30%. So let's say your credit limit is $500. 30% of that is $150. So each month, you'll want to put a few purchases on the card, totaling no more than $150 throughout the month. So you could use the card for a few meals, use it at the gas station, or if you really want to keep things simple, use it for a couple of digital subscriptions that you pay for anyway, like Netflix or Spotify. That way your card is getting some usage every month, but you know it's staying well within that 30% utilization rate. Step 5, graduate to an unsecured card. After you've got about 6 to 12 months of perfect payment history with your secured card, you'll be ready to move up to an unsecured card. An unsecured card is a traditional credit card where you're not required to put down a deposit. They'll just give you a credit limit based on your creditworthiness. Then when you start using this card, you'll want to follow the same exact rules. Set up autopay, pay off the balance every month, and avoid using more than 30% of your credit limit in any single month. Meanwhile, you're still going to have your secured card, and I would recommend keeping that account open indefinitely because it adds to the overall length of your credit history. And if you chose one of those cards with no annual fee, it doesn't cost you anything to keep it open. Step 6, request a credit limit increase after 6 to 12 months. Once you've established a solid payment history and you've been using your card responsibly, you'll want to start increasing your credit limit. Why? Because the higher your credit limit, the lower your credit utilization will be, assuming you're not drastically increasing your spending as well. A good rule of thumb is to request a credit limit increase every 6 to 12 months or so. And these days, this is really straightforward to do on your credit card company's website or app. There's usually a button where you can request an increase. It'll tell you if you're eligible. And if you are, it'll go ahead and grant the increase right then and there. A higher credit limit gives you a little more breathing room when it comes to managing your overall credit, and it can definitely improve your score. Just be careful not to start spending more money than you otherwise would just because you have access to this credit line. Again, treat your cards like cash and pay off the balance every month. Building credit from scratch does take some time, typically 18 to 24 months to reach a good score. But if you follow these steps, you'll be setting yourself up for long-term success. Remember the fundamentals: consistent payments, low utilization, and patience. Thank you so much for watching. If you found this video helpful, I'd love it if you would hit that like button and subscribe for more videos like this.